This is Splice.
Okay, hi everyone. I guess we're just going to start. Very quickly, this session is about, I guess, how to buy other media companies as a media company. So kind of bear with me. I guess our company is the best example use case of this. So for the first 10 minutes, I'm going to very quickly machine gun through our history. Since over the past, I guess, 4.5 years, we've done 9 different acquisitions. So on average, 1 every 6 months. So it will seem like the first few pages are kind of like free marketing. We're introducing ourselves, but trust me, when I get to the end, there's a reason for this. So very quickly, we're TNL MediaGene. So we originally started almost exactly 10 years ago on the very top left side. We were the original, originally the brand was the News Lens. It was meant to be starting from Taiwan, but eventually, hopefully, Greater China, most parts of Asia, to be a large independent digital news brand. And gradually, over a few years, we launched a Hong Kong edition, a Southeast Asia edition, an international English edition, and about a year ago, we launched our Japanese edition. What kind of made us pivot about 4.5 years ago is when we realized we're about to plateau out, as in the Taiwan market in itself was a little bit too small. So we started pivoting to becoming a media group. So we started acquiring other smaller media verticals. And once our readership hit a certain scale, we started acquiring other MarTech, AdTech, or data analytics services to actually monetize the data that we were collecting. So that's kind of how we went through everything stage by stage. So right now, as a big picture, we have about 29 different media brands, of which the super majority are all acquired. We have 6 offices, 3 in Taipei, 1 in Hong Kong, 2 offices in Tokyo and Kyoto, about 560 people, of which I would say 80% were actually acquired over the past 4.5 years. So this is how, I guess, everything fits together now. We have about 50 to 60 million monthly unique readers across 4 or 5 different languages. In terms of monetization, even though the original DNA was independent media, right now it's roughly around 1/3 is media advertising. So basically, programmatic banners, campaign. 1/3 of it is actually data analytics, AI, SaaS, tech services, and 1/3 of it is actually e-commerce, agency communications, paid events, paid membership, et cetera, et cetera. So like I said, from the Taiwan perspective, we're about 10 years old. We started with the original News Lens, independent. The idea was no political junk, no corporate agenda, only newsworthy content as objective or as fair as possible. We grew for the first 4 years, and around 2018, we realized we had to pivot. So we started doing M&A. So as previously mentioned, we've done 9 or 10 different acquisitions, on average 1 every 6 months. The first few acquisitions were other smaller media brands. But starting around 2019, 2020, we started acquiring a big data market research firm, a mobile AdTech company, an AI CDP company, e-commerce. And about 4 months ago, we merged with MediaGene. That's why the company is now called TNL MediaGene. MediaGene is one of the largest digital media groups in Japan. So kind of like our exact opposite without the tech and data part. So MediaGene is about 25 years old, kind of very similar trajectory, except, again, without the tech and data part. They started with 1 or 2 different media brands, started diversifying into other different media brands, and started launching into communication, agency, e-commerce, paid memberships, events, et cetera, et cetera. So they have about 30 million monthly uniques. We have about 20 to 25 million monthly uniques. They're all in Japanese. We have Chinese language, Cantonese, English, and Japanese. So this is our more famous, I guess, international investors. There's North Base Media, our seed, Series A, Series B. 500 startups from Silicon Valley came in during our Series A. Steve Chen, Kevin Lin came in during Series B and Series C. And during Series C and Series D, the managing directors of Amazon Ring, Google Nest, Draper Associates is the VC fund of Tim Draper, the early investor in Tesla and SpaceX. And on the Japanese side, when we merged with them, their investors naturally became our investors. So DAC Consortium is an investment arm of Hakuhodo. And Isetan, the mall, Shiseido, the cosmetics, and Mizuho Bank are now also on our cap table as well. So combined together, 50 to 60 million monthly uniques. That's how we slowly started growing after we started acquiring companies. So at this point over here, it was basically still just one brand. And then gradually, after every acquisition, we started growing, I guess, creating the so-called snowball effect. This is how everything now fits together. So everything on the left side are the 29 different media brands. Everything in the middle is the MarTech, AdTech, Big Data Market Research, AI CDP. And everything on the right is the agency, communications, e-commerce, paid events, paid membership. So in terms of revenue breakdown right now, roughly it's 1/3, 1/3, 1/3. 4 years ago, for example, it was 99% on the left side. 3 years ago, maybe 80%. What we've been trying to do right before or right around COVID is as quickly as possible, diversify, diversify, diversify. So we wanted to diversify from one language, from one market, from one media vertical, and gradually across different services, different tech, different languages, different countries. So if there's one theme over the past 3 or 4 years, it's quickly diversify. That way, whenever there's a COVID, there's a lockdown, borders are closed, something will go down, but something will go up. And in our experience, that's how you kind of hedge against all the risks of media. So just very quickly, the original TNL, that was the original first brand, serious news, no political junk, no corporate agenda. And then we acquired one of the largest tech medias in Taiwan, one of the largest gadget medias in Taiwan, et cetera, sports media, lifestyle, movie, Korean culture. This is our youngest finance media. End of last year, we acquired iCook. It's the largest female interest / food recipe media, but also has a huge e-commerce and paid membership service. So for example, this is the kind of deal that we would do. We originally had very little paid membership. We had no e-commerce. And now that we acquired their team, we're asking their team to create e-commerce across the other brands that are suitable for e-commerce. On the Japan side, their biggest brands, Gizmodo Japan, they run Lifehacker, Rumi, their own brands. Their flagship brand is Business Insider Japan. So right now, actually through them, we're applying for Business Insider Global Chinese rights. So hopefully we'll get that. I guess we'll know in a few weeks. Mashing Up, DigiDay, et cetera, et cetera. These are the things that we have on the Taiwan side that they don't have on the Japan side. So we have Big Data Market Research. We have the largest mobile AdTech company in Taiwan. And DataX is our own AI CDP firm. On the Japan side, they have an agency communications firm, and we also have an agency communications firm. So very, very similar. Just very quick overview of all the different content. So of course, we're all digital native. So infographic, more digital storytelling, more interactive content, podcasts, videos, explanatory videos, short-form videos, and different online discussion boards. Major paid events, both on the Japan side and on the Taiwan side. And this is a quick summary of all the different tech and data products. So all of this originally was on the Taiwan side. We spent the last 3 years being stuck in COVID, basically trying to R&D all of these different, we think, future monetization products that will allow us to organize, monetize all of the data points that we're now collecting. So from big data market research to mobile ad tech to AI CDP to different SaaS platforms. These are the things that we think we have on the Taiwan side that coincidentally the Japanese side was missing. So over the past 4 months, we've been sending our tech and data teams every few weeks to give them this as fast as possible to allow them to do faster digital transformation, increase their margins, increase their profits. So this is what we think are the tech and data synergies. So this is how everything basically fits together now. We think the future of digital media more or less has to be 50% tech and data company. And that's what we've been growing over the past 3 or 4 years. So on the left-hand side, still 29 different media brands across different topics, different languages. But that's also a data source for 50 to 60 million zero-party data, first-party data, third-party data. Everything is GDPR and privacy issue compliant. And in the middle is basically all the in-house tech, data, AI capabilities that we've been trying to build over the past 3 years. So we don't want to give our fate to Facebook or Google. We want to keep everything in-house and be able to actually control our data fate. And on the right side are all of the different diversified data products that we've been trying to build over the past 3 years. So, AI algorithm engines, big data tracking, market research, consultancy, et cetera, et cetera. So again, the theme was 4 or 5 years ago, 99% of all of our revenue was here. We want to quickly diversify as much as possible. So at some point, I would not be surprised if media advertising in 2 or 3 years is only 20% of our overall revenue. That way, again, we hedge, we diversify, we try to keep and protect independent media. So 6 offices, like I mentioned right now, about 560 people. It's kind of hinted over here. Now that we have most parts of Greater China, Northeast Asia, our next acquisition target will be Southeast Asia. We're looking at possible targets in, for example, Singapore or Malaysia. We want to, as quickly as possible, finish the Asia story, the Pan-Asia story. So the pitch is we want to be the largest Pan-Asia, multi-market, multi-language, independent content, tech, data, AI, e-commerce group of companies. And hopefully we can achieve that in the next 1 or 2 years. So that's roughly where we are right now. So to come back, I guess, to the topic at hand. Why, first of all, why must we M&A? So going back to the history a little bit, so Taiwan is very, very small. Population 23 million. Heavy internet users, about 80%. Of that, maybe 70 to 80% actually read news, regularly. So your regular news audience in Taiwan is about 10-ish million. So by year 4, the original independent serious news brand hit about 7 million monthly uniques. And you kind of feel like the growth was actually about to plateau out. So something that makes us, I guess, very, very different here is that we took institutional VC money, so-called investor money, very, very early. So we had our seed, we had our Series A, Series B, as mentioned before. So we always knew, in a way, that I could never go back to my board or investors and say, oh, we're now the largest independent serious news brand in Taiwan. That's it. We're not going to grow anymore. You kind of have to hit certain growth milestones, certain growth scale every year. In a way, I'm always joking. The past 4.5 years, this has more or less kind of become a numbers game. We can kind of guess what the expected growth rate has to be. And you can kind of guess what the end result has to be. And if organic growth is not going to satisfy that, then our only option at the very end was M&A. So it's a classic Asian small market problem. Taiwan in itself is too small. Hong Kong is too small. Singapore is too small. But if we took institutional VC money very, very early on, then we still have to satisfy, return on investment for our investors while still balancing independent media. We're not going to sacrifice the original independent media DNA. So we're not going to force them to create junk content or create page views for the sake of page views. But that being said, we still have to grow a certain 30% every year. Then how do we balance that? So I guess there are 2 ways. One is to continue growing outside of your original home market, so internationalize your readership. So we've been doing that. So hence the Hong Kong edition, the Southeast Asia edition, the international English or the Japanese edition. After looking at those numbers, we realized that forcing editors to grow 30% every year is not very, very reliable or not a very good long-term strategy. There's only so much you can grow every year. Then the second idea was, okay, then maybe it's time to start growing horizontally. So if we have serious news, then maybe it's time to start growing, tech news, sports news, gadget news. So that was the original idea. So 5 years ago, we were still very, very naive about this. So 5 years ago, we honestly thought, okay, then maybe we will create our own TNL sports, TNL tech, TNL gadget. So 5 years ago, if you went to my office, at the very end of the office was an Excel spreadsheet where we did a market research comparable of most parts of Greater China or Asia independent media. So for example, there might be 30 different independent media companies in Greater China. Let's say, across Taiwan, Hong Kong, Singapore. And let's say, 5 are serious news, 5 are female interest, 5 are sports, 5 are gadgets, etc. What's their scale? Who are their investors? What's their revenue? And roughly how much they're valued. So you do a rough market research of Asia. And let's say there are 30 of them. I remember the enlightening moment, the pivot was after doing the market research, we were very surprised to find that if there were 30, for example, the first 27 were basically all losing money. So it was that moment where you realized, then why would I spend 5 years to create number 31 and we would still all lose money? So that's the pivot when we realized, okay, then maybe the digital media or the so-called new media industry is just like the cable industry or the telecom industry 10, 20 years ago, where no matter what, Asia, most parts of the countries are just too small. So the game is you can be number 1, you can be number 3, but if you run out of money and you're still number 7 or number 9 or number 11, we're all going to die. Then so why would I create number 31? So then the idea pivoted to become, okay, then maybe it's time independent media started consolidating other independent media. So that was the pivot. So we decided at that point to go from one media brand to becoming a media group. And once we went from 7 million, 10 million, 12 million, 20 million, we started focusing on the next stage. Whereas, okay, we now have enough readership. It's now time to start thinking about revenues. And at some point, after we had enough revenues, it was start time to thinking about profits. So there were 3 different stages of the company's natural expansion. So we've done this basically, again, 9 times over the past 4.5 years. The good news is we've never done this before either. So all of this can actually be learned. You kind of go and learn as you go. As a startup, we were about 4.5 years old when we started this process. We don't have an investment banking team. There was no real professional, a full-time advisory in the office. You just kind of go as you go. We will continue to do this probably for the next 3 to 5 years, on average, 2 deals every year. On average, it's been 1 media deal every year and 1 tech or data deal every year. Because we want to get the readership scale from 50 to 70 to 90 million readers, while at the same time we have to make sure, hand in hand, that the tech, data, and AI engineering capabilities to actually monetize these data points grow hand in hand as well. So the flywheel, or the stupid general example is, it's very hard for media companies to make money. Very hard, or too slow. So we've been trying to acquire other complementary tech and data services that can allow them to connect with the media part of the business, but make their services more precise, more accurate. The extra faster revenue that they create and the profits that they create, we will reinvest in independent media and, in a way, protect independent media. So that's the positive flywheel we've been building over the past 3 or 4 years. So I guess some technical questions first. One of the most common questions I get is, how do you value a target company? Well, the good news is, if you ask them, when was your last funding round? And if they had a funding round last year, then that's your basis point. Technically, if they had a last funding round, it's not too hard. If they said, oh, we just closed an angel round last year, we were worth 1 million at 1 million monthly uniques, for example. And if they now have 1.2 million monthly uniques, then you kind of have an idea. Then the valuation will grow in proportion. Usually, in my experience, the worst kind of negotiation is when they have never taken any funding whatsoever. They have no market comparable. They have no anchor to discuss this negotiation. That's very, very difficult, because you ask them how much are you worth, then they'll give you a crazy number typically. Typically, it's the 2 scenarios that are impossible to negotiate. 1 is if they've never taken money before, and 2, it's when the founders are very, very rich themselves. It never works. Because at some point, they will tell you, I don't care about money. Then you know this conversation is gone. If they don't care about money, they'll toss you a number. Oh, I think we're worth 50 million. And you do the numbers. It's only worth 5 million. Why 50 million? And they'll tell you a whole spiel for an hour about why we're worth 50 million, but none of it is actually based in reality or numbers. So if they have a recent fundraising round, it's not too hard. If they have a comparable or industry valuation multiple, it's not too hard. So again, for example, if you're a tech media, and on average, all of the world's tech medias trade on a 1 or 2x multiple of revenue, then you already have a rough range. You're somewhere between 1 to 2x revenue. So using comparables is also a very good idea, or industry multiple, a valuation multiple. The 3 most common multiples to value a media business, number 1 is sales. So on average, it could be anywhere between 1 to 5x, for example. 1 to 5x of revenue basically means if you're doing 1 million of revenue, then your company could be worth anywhere between 1 to 5 million USD. Depending on how good you are up and down. Sometimes it's based on EBITDA. So EBITDA is basically how much money we're making. Media companies could be anywhere from 30 to 60x EBITDA, but 99% of the time we're all losing money anyway. So it's usually not a use of EBITDA, or it's a proxy. So what I mean by proxy, it's something to prove our scale, something to prove our growth over the past few years. And within most of the media industry, usually that proxy is monthly uniques. So you have 5 million monthly uniques. This person is worth 10 million. Then it's a 2x multiple. If this person is 10 million monthly uniques, then you kind of have a rough ballpark. They're probably worth about 20 million USD, roughly like that. Okay, so how much cash and how much equity do you offer them? Depends very much on whether or not you want the original founders to stay. So for most of our deals, it's always roughly been 1/3 cash, 2/3 equity, because we want the original founders to stay. Because again, if we buy a tech media or sports media or gadget media, we originally did not have a sports, gadget, or tech editorial team. So the point was to buy other pieces, missing pieces of the puzzle to add on to our original piece of the puzzle. So we want them to stay. So if you don't want them to stay, for example, then you can all be cash and they can leave. But for us, it's usually a combination of the both. So just to use our first example, Inside at that time was the second largest tech media, kind of like the TechCrunch of Taiwan. This actually follows this formula. I met the founding team. I asked them what was their last round. Their last round was literally 1 million USD, and they were doing 1 million monthly uniques. So immediately, okay, that's about 1x monthly uniques. Then you ask them a year later, how many monthly uniques do you have? They have about 1.2 million monthly uniques, and all other of your metrics are more or less roughly the same. Then you can have an idea that the valuation is roughly 1.2 million. Then once you have the total price confirmed, you actually ask them, how much are you guys willing to accept in terms of cash payment versus equity payment? Of course, everyone will say we want the more cash as possible. As the acquirer, especially if we're also a startup ourselves, we don't have that much cash. It's our goal usually to lower the cash as much as possible. So in our experience, the fair offer is you actually ask them, in your company's 5, 8, 10-year history, what's the opportunity cost that all of your founders spent over the past 7 or 8 years? So in Inside situation, their 4 founders over 8 years put in about 400,000 USD in cash. The company's worth 1.2 million. So our offer to them literally was, okay, if you guys put in $400,000 in cash, that's your expense, we will offer you $400,000 in cash. So the mentality was, we will protect your downside as an entrepreneur. But whether or not you will make any money, be really rich exits, we have no idea. The only way you will know is if you join us and allow us to merge you. And the remaining 0.8 million becomes equity swap, as in their shares are swapped to TNL shares, and we merge to become one entity. So typically this works. Psychologically, again, 8 or 9 times, all of our 8 or 9 founders over the past few years are all still in the company. None of the founders that we bought have left. Because psychologically, we protected their downside. So as an entrepreneur, at least they haven't failed. But whether or not everyone will make money together, we will have to see all the way until we exit or IPO together. Okay, so that's the 0.8. Psychologically, it's roughly around 1/3 cash, 2/3 equity, because if you give them more than 51% cash, psychologically they feel, the company is already more or less sold. I can leave or quit or just be lazy whenever I want. So 1/3 seems to be a good point or a reference point, at least for us. So I'm sure the key question is, then as a startup, how do you get the money for the M&As, right? And the answer is, as a startup ourselves, keep in mind, when we started doing this, we were only 4.5 years old. We did not have any money. We did not have 400,000. We did not have 1 million or 2 million. So where to get the money for M&A? So the tricky thing about this is, of course, it's through fundraising. We've done 5 rounds of fundraising over the past 10 years. So on average, one round every 2 years. We plateaued out at around Series B. So around Series B, that was when the original TNL was starting to plateau out. Taiwan was too small, Hong Kong was too small. So starting Series C, we started fundraising for the idea of buying other companies. Now it's very, very tricky to balance this because previous investors oftentimes are a little bit hesitant to allow you to to fundraise first because everyone gets diluted. So our way around this was that we actually buy the companies first. We buy the companies first, and then we fundraise at a much higher valuation. The existing investors are happy because the pie is bigger, and you get the money to pay off for the previous acquisition. Many people's expressions here are very confused about this. So I'll give you an example. Going back to Inside. So the cost for this is just like math class, is 1.2 million. I have to cough up 0.4 million in cash. As a media startup, I do not have 0.4 million in cash. If at that time, TNL, let's say, was valued at $30 million, let's say, okay? And their valuation cost is 1.2 million. So logically, our cost is 30 million plus 1.2 million. Okay, but when I go fundraise, I do not fundraise at 31.2 million. The combined story is bigger. It's a group now. You try to persuade your new investors that the new group is now worth 50 million, for example. There's a premium for M&A. There's a premium for being a group. So what happens is, this is actually real numbers. We persuaded them to sign the deal January 1st, 2018. They moved into our offices January 2nd, 2018. And on January 3rd, we issued a huge press release that said, for the first time in Taiwan history, independent media has started consolidating smaller independent media. And then based on that press release, we actually started fundraising. And we actually started fundraising not on 31.2 million as a cost price. We fundraised at 50 million. So the pie is much bigger. Your existing investors are very happy because your valuation is going up. The catch of this is we still have to pay them 400,000 USD. So it's actually written in the contract that we had 4 months to pay them 400,000 USD. So we started fundraising in January. The deadline was basically April 1st. So you start fundraising. So you try to raise at least enough money to cover their 400,000 within 120 days. You get the money, you pay them off immediately. Okay, so it's almost like a leveraged buyout in that sense. I remember very well when we finally raised the money to pay them. The deadline, let's say, was April 1st. We were 10 days away from the deadline. Okay, so we got, let's say, $1 million. We quickly paid off 400,000 to them, 100,000 to the lawyer fees or whatnot. We were 10 days away from bankruptcy. Okay, and we've done this 9 times. And each time gets bigger and bigger and bigger because the deal gets larger and larger and larger. The smallest deal was 1.2 million. The largest deal so far, just within Taiwan, was 18 million. So the cash we had to cough up was about 6 million. So you have 4 months to raise 6 million. And then you have to persuade them to accept this, merge first, and then you have 4 months. Whatever comes in through your left hand goes out through your right hand within 120 days. Okay, so that's how we did basically 8 or 9 of these deals. The Japanese deal was the only exception because at that point they were so big and we were big enough that we persuaded that the Japanese deal was a pure merger. It was a pure equity swap. Yeah?
This ever not work for you?
I'm sorry?
Has this ever not worked for you?
So far, no. But it does get scarier and scarier, of course. Because, the size is getting bigger and bigger. And fundraising is difficult, very difficult, especially during COVID, whenever there's a macroeconomic factor or whatnot. So we've been very, very close a few times. 10 days away from the deadline, 5 days away from the deadline, 2 days away from the deadline. But I've had 5 years to think about this, and I still can't find a better way. I mean, disregard a better way. I can still find another option. Again, going back to our dilemma. Yep. Both. So first time, we had no idea what we were doing. By the 3rd, 4th, or 5th deal, there's basically an operating process. We know what multiple we're looking for. We know what multiple we want to fundraise. We know what we're missing in terms of the next story, and we kind of arbitrage with that. And of course, the numbers are an average of what's the market comp and what we're looking for. So by deals 5 or 6, there's a formula to all this already. We now have sports. We're looking for female interest. We now have Chinese language. We're looking for Japanese. We now have Japanese. We're looking for English language or looking for AI or engineers to boost our team. So there's a rough, almost like a supply chain blueprint of how this needs to grow. So for example, we already roughly know what our next probably 4 acquisition targets are. And we're trying to time them according to good market timing for a better price or a better cost. So it's an art at first, but at some stage it does become a science. Yes.
Have you ever
Have you ever targeted legacy media in the region? What are the upsides or downsides?
Yeah. So the funny thing is, the first time that this happens, everyone is kind of watching. I remember very well, by the third deal, there became this pattern where every time you announce a press release that, oh, you bought a tech media or sports media, you'd be very surprised. The next day, 10 different media companies will email you saying, do you want to buy us? And you had no idea out of these 10, for example, oh, these 5 are for sale. Oh, these 5 are not doing well. Oh, these 5 are actually looking for a buyer. So out of those 10, for example, yeah, sometimes they're legacy media players. And our short answer is we'll keep an open mind and look at everything. But like I said, strategically, we have a rough idea of who we want to acquire next. And again, there were, I think, during our third to fifth deals, a few legacy media players in either magazines or newspapers. We've traditionally always kind of shied away from that. Because again, we're 8, 9, at that time 6 years old. We have no experience in legacy. We have no experience in print. It's next to impossible for us to reverse and merge or take over a legacy media operation. I think it would be too much trouble for us, and it's not something we're naturally good at doing. So, of course, there are offers. Of course, we'll look at it. But so far, we've never pulled the trigger on legacy media before. Yeah. So, this is like you're leveraging more and more. I always call the investors that we take over my in-laws. So within the company, that's my joke. Because when you equity swap with target companies, the funny end result is their original investors become your investors. So in a way, it's really kind of like a marriage. You marry someone, and all of a sudden you gain a lot of in-laws. So because of the Japanese merger, for example, we now have 50 Japanese in-laws. And half my day job is basically trying to manage all of these different in-laws. So to answer your question, yeah. So now you've kind of inherited so many of these different investors. At some point, everyone needs an exit, right? So let me finish the slide first, and I'll answer your question. But again, if this is something people are thinking about, in our case, I think this is the rough principle that we should think about. So are you in a local market of which the ceiling is coming very, very soon? The market is too small. In our experience, probably if your home population has an online readership of less than 10 million, probably too small. Number 2, have you taken outside investor money and you must achieve certain growth or scale in a certain period? So I don't know if most of you have heard, for professional VCs, PEs, or institutional investors, there's a so-called 7+2. As in, when investors give you money, within 7 to 9 years, so let's say it's 8 years on average, they have to see that as a return. So to your point, yeah, we knew this going on because I think compared to most media startups, we took money relatively early. So when we were taking money relatively early, in the back of our minds, we already knew, in about 8 to 9 years' time, everyone needs an exit. Then that means we get big enough that we're sold, or we get big enough that we IPO. Yeah, so we're actually aiming for an IPO next year. So you've promised enough people, the dream. And sooner or later, you still have to deliver on the dream. And that's also why they join you. If you think about it, 2/3 of it is equity swap. So they expect that equity to be, rewarded one day. It's your job to actually find that equity option at the very end. So number 3, I think, is probably the most direct or serious question we have to ask. As in, is your home market too small for you to achieve operational break-even? So for us, roughly around the time we were merging our second or third companies, personally, I made this decision that it would be too slow, definitely, for the original core serious news business to break even. Even if it did, it would be your classic mom and pop shop where, every year your monthly revenues would be this much, your expenses would be this much, so you have to cut expenses just to break even. And you're never going to grow beyond that. So Taiwan is too small. Again, Hong Kong is too small. Singapore is too small. So if your home market is so small that it has a very little chance of allowing your original serious news or journalism product to actually break even, then we have to find another way. And for us, our finding another way was through acquisitions. So I often very cynically say sometimes, after looking back at this over the past 5 years, I don't think we had a choice. I honestly can't think of a better option, even though I had 5 years to think about this now. I honestly think this was the only way for us to kind of break through in terms of this plateau. So, yeah, 4 and 5 are the same. Is the original media business basically unable to provide the sales and profits necessary for long-term growth? So again, the biggest hint for me was going back to that 30 media companies in Asia. 30 of them at that time, 27 of them were losing money. So if 27 of them are losing money, then from a pure financial standpoint, that means this market is so small that it can only naturally sustain 3 companies. Then the name of the game all of a sudden becomes, how do I, if I'm number 5, how does number 5 buy number 7, buy number 9, and at the very end, we're within the top 3, and then we can self-sustain. But if we run out of money, if everyone runs out of money, and we're still only number 4, number 7, number 10, we're all going to die. So the game becomes, how do we achieve scale together and don't create number 31? Okay, so if most of the answers to the above questions are yes, then M&A is probably a serious option for us to break through our limited market size, of which we had no choice from the beginning. And again, the very cynical part of me actually thinks it might be one of the very few options, or maybe the only option. In this day and age of self-media, Instagram, YouTubers, KOL, there are too many people taking two remaining tiny chunks of media budgets, of which 80% are all taken by Facebook and Google. So we have to fight for the final 10%, and it's not enough to sustain 30, 40, 50 different media operations. Then logically, I guess the only way is then how do we grow to a certain scale of which we can actually control our fate. And once you control a certain scale of your team, you can build a data team, an AI team, a MarTech team, and then you have a much more strong narrative for other people to join you. So I guess the final point is, on a bright side, maybe this is not very special. Maybe this is not unique. Maybe the digital media industry is just like the cable industry, is just like the telecom industry, where every industry during a middle phase, a chaotic phase, has to go through this. And we're going through it right now. So in many ways, maybe we're not special at all. We're simply going through a normal market consolidation phase, except we just we try this first. And so far, we're still learning as we go. Then if that's the case, then logically, you will see more and more media consolidation in Hong Kong, in Singapore, in Japan, or across Asia. And that's a natural evolution of this industry. Okay, that's my last slide. So yeah, I still have a few minutes. Any questions, please?
Hiya. Other than the valuation that you laid out in terms of when you're considering acquiring a media company, are there any other considerations that you look at, specifically audience-based considerations? Thanks.
Yeah. So first and foremost, the original DNA was independent media, no junk, no fluff. So that's still the same idea when we acquire other media companies. It can't be too far away from that. It can be tech news, gadget news, but it can't be content farms or junk content. So the DNA has to mold. So to be honest, whenever we're acquiring other media companies, I actually take it to our editorial team and say, these are the 3 targets I'm looking for. Veto out the ones that you're not interested in. And if you, for example, this one is the highest quality, but it's the second largest, not the first largest, I will respect our editorial team. So oftentimes I want to buy the largest, but if they think there's something wrong with their content or it's not respectful, there's plagiarism issues, we can veto off the first one and go after the second one. So that's in terms of media. So the media still has to be someone you're very proud to merge with. It has to fit your original DNA. At a certain point, after you've achieved enough scale in media, your second stage of acquisitions are revenue. So I'm looking for other business models that are complementary to digital media that by merging with them will allow them to make money faster. And when they make money faster, again, we will take the profits and reinvest and protect independent media. So I would say there are 3 different stages of the criteria. For the first stage, we did not care about revenue. We did not care about profits. For the first stage, it was all about media scale. We were buying monthly uniques. On the second stage, once we had a certain amount of monthly uniques, we were buying revenue. And on the third stage, once we had enough revenue, we were actually buying profits. So it just depends on what was missing during that time. So for example, very, very, very simple example right now. Again, I mentioned we're aiming for IPO next year. So you have to align up your scale, your revenue, and your EBITDA. So the criteria now when we're looking for companies is that company itself has to be profitable. we're not going to buy a company that's losing money now because we spent the last 3 or 4 years cleaning up our financials. We don't want to actually go backwards. But this was not the case 3 years ago. We could have bought anyone. We didn't really care if they were losing money. We were buying scale at that time. So different moment, different stages, different targets.
Revenues. Could you say a bit more about that?
For sales or for monthly uniques, for example? Sales, right? Okay. Well, the short answer is that's just the market average comps. So, it could be all investment bankers will give you 30 different examples of all of the public media companies, and they're all trading at 5x revenue, for example. When, for example, New York Times buys a company in 3 years ago, they might have paid more, and it was 8x revenue. Or some transaction might have happened in Asia during a downtime last year, and that transaction total price over revenue was 3x revenue. So the point is, when you're doing this research, you will have a range, and everyone's looking at the same companies. So there will be a natural range. It's anywhere between 1 to 5 or 2 to 4x within that market, within that industry, for example. So that you don't control. What you do control is whether or not it's a good market or a bad market. So that range in a bad market could be 1x. In a good market, it could be 5x.
Listed valuations in media are, say, a PE of maybe 10 times, right?
Yeah. So that's EBITDA, right? PE.
Well, no. Price to equity. I mean, price to profits. Profits to equity.
Yeah, typically media companies don't want to use EBITDA because no one is making that much money. So typically, we always try to argue revenue multiple. Revenue multiple is a better story. It implies future growth. EBITDA kind of implies you're kind of stuck here, and everyone's going to do 1 or 2% EBITDA. So typically, the argument is always for revenue multiple. So we try to go after that. Does that answer your question? But as you get more and more dynamic, it becomes an average of different things. So for example, when investment bankers are valuing us, we're not solely digital media comps anymore. Since our revenue now is, again, 1/3 digital media, 1/3 tech data, and 1/3, let's say, e-commerce, then literally they take the average multiple of media times 1/3, the average multiple for e-commerce times 1/3, and the average comps multiple for AI or tech times 1/3. And you average out a rough multiple during that time. And they'll actually tell you, oh, this is a bad time, so it's actually at a 30% discount. In a good time, it's higher. So yeah, there's always a range.
I'm very curious to know what kind of internal corp dev team size do you have, and what is the ratio of outbound deal making towards inbound deal making?
Outbound deal making?
As in, do you guys actively go out and seek deals, or do you receive inbound from bankers, etc.?
Yeah. We don't really have a corp dev team. I do 90% of all the deals. I have 2, research assistants that do the market research. And we have like a list of, by this point, we've probably looked at over 100 Asian companies across digital media, tech, data, e-commerce, everything. So in the back of my office now, there's like a 200-page list of all the different media companies or all the different tech and data companies, what they're worth, what their sales, who their investors are, everything. And we refresh that every 6 months. So my staff helps me do the research. And out of the, let's say, 100, 10 fit the direction that you're going for. You would love that data? Okay, come find me afterwards. So let's say out of those 10 are the ones that we're interested in. We just simply usually send them an email or LinkedIn, or sometimes we meet at these events. At some point, the media circle in Asia is not that big. Everyone knows everyone. So even if you come across a company that we've never encountered before, let's say in Hong Kong or Singapore, usually you call someone and someone will make the intro. So for example, the Japanese company that we merged with, we had never met them before. I was actually going after another target company. And during a Zoom call with that Japanese company, he politely said no, but then said, oh, but the kind of target that you're looking for sounds very similar to this company called MediaGene. I would be happy to make an intro. And so you never know. You really never know. But if you have a rough direction that you're going for, you kind of know how to kind of time this. And you just see kind of what hits, basically.
So, sorry, less finance talk, but in terms of how do you ensure that when you merge or do a equity swap, that the culture of these different companies are still intact? Because I know that can quickly drain down the team, which is also part of the evaluation.
So let's talk about the companies within Taiwan. They're a little bit easier. We've done 8 acquisitions in Taiwan. The first 6 were small enough that they all moved to our offices. So that typically solves 70% of the problems. So the overall policy of integration is anything that allows us to make more money together, we will integrate. So for example, the sales team. Typically in our experience, the people that are happiest are the sales team and the IT team of that original, let's say it's a media company. Because if their sales team was originally part of a very small media vertical, they could only sell 1 million monthly uniques in a tech media or in a gadget media, for example. But once the sales team is completely integrated, the sales team is very, very happy because all of a sudden you go from 1 million monthly uniques to 20 million monthly uniques. You know, your bonuses go up, your playground, your arsenal is much bigger. Same thing for the tech team. Typically the tech team is also very, very happy because you're maintaining one small website before. And now the tech team is integrated. You have 9 different media brands to actually maintain, create data products, create UI, UX products. It's a lot more fun. So the policy is anything that allows us to make more money together or save more money together, we will integrate. Anything that makes no difference, or for example, we have no expertise, we will keep independent. So all the other media companies that we acquired, their editor-in-chief and their editorial team is still completely the same. We've never touched them. In fact, one of the most common compliments, to me it's a compliment, is when we're meeting other companies and we give them our name cards, and they'll look at our name cards and they'll say, oh, for example, Inside. And the other person will say, oh, I've been reading Inside for 8 years. I had no idea you guys bought them. From my standpoint, that's actually a compliment because we never touched, we never interfered with the editorial independence. So the idea is, at some point there might be 30, 40, 50 different verticals on top. It's like different trees, Your readers are still the same, that they don't feel that there's any difference. Maybe your content quality is even better now. But in the bottom, all of the tech, data, monetization is integrated. So everyone makes more money faster and saves more money faster. And typically that solves 70, 80% of the problems. The 2 companies that we acquired that were too big to merge into our office, we definitely have more integration issues. Because they kind of feel like, they're Hawaii. They're like really far away. And we have to run over every week. Even their tone, they still say you versus us. Even though we completely own them, but they have a separate office. So as quickly as possible, we want to move offices together to kind of solve this. But again, our learning is if you create the value in terms of monetization, if you create the value in terms of saving money, and for the founders, don't forget, for the founders, 2/3 of their entire value as an entrepreneur is tied to our stock together, to IPO together. They will help you solve problems because they don't want to see the integration process become too chaotic either. Okay, I guess my time is up. But anyway, I'm still here if you're having questions. Thank you.
This is Splice.